John, I actually think your call is original in the sense that I don't think it's too dependent on rate cuts next year in quite the same way as it is elsewhere. John, can you just go through your framework, the path to 5,200 on the S&P?
Yeah, great to be on surveillance as always, John. The thing about this is, when we look at it, we think the traders right now are pushing this dream of 4 rate cuts next year. We think the economy is showing significant resilience in the face of, 11 hikes and 3 pauses thus far, or skips, as the Fed prefers to call it. The Fed has shown remarkable sensitivity as it practices its mandate to keep untoward levels of inflation in check. And so all in all, we think this looks good, as with cuts likely to happen in the second half of the year, and probably maintain mostly, if it's going to happen, probably in the fourth quarter, and then only once or twice.
John, there is a shift going on. I saw it from our Gina Martin Adams at Bloomberg Intelligence. It's obviously Stoltzfus 101. And also the great Urian Timmer, chart guy at Fidelity. There is a shift to earnings analysis. We're moving away from Fed navel-gazing to OMG, look at revenues, OMG, look at earnings. We've seen this before. How does the market react?
We think the market is actually well positioned to react positively to it. It's not only about traders, it's intermediate and longer term investors and traders that create the environment. I mean, the markets are like music. It's math and emotion. It's fear, greed, and need. So some people invest for need, others invest for the short term, the fear and greed aspect. And we think it creates, I don't want to call it a cocktail because that sounds a little bit too volatile, but it creates an opportunity where if we focus on earnings in an environment where it's the end of free money, where bond issuers have to pay for the privilege of borrowing money and bond buyers get something in return, this just looks like a more normalized environment, and we like it.
Does it make you nervous that everyone seems to be agreeing with you these days?
Oh, it sure does. That's the one thing. We saw an awful lot of the bears who last year were telling us about the pending recession and the massive unemployment that was coming. And all this stuff that was negative. They took the negative pitch book sold last year, and it's what we believe really caused the market to decline as it did last year, on things that were never realized. And so the bears have pivoted, but when they pivot, you get that feeling, if you're on a boat, all of a sudden everybody's on your side of the boat. You start looking for a little ballast. And that might well be in terms of taking advantage of some of the diversification that fixed income offers, as well as other areas of the market, of the equity market, that have yet to participate in this rally.